Accenture. Let there be change.
Hi, everyone. I'm Carol Massar, an anchor at Bloomberg Businessweek Television and Radio. Welcome to Thriving in the New Normal, leading through geopolitical volatility and compressed transformation. A global pandemic, climate change, and geopolitical instability have all really changed the way we live and do business. In order to succeed in this new unpredictable environment, corporations need to be prepared, agile, and adaptable. We hope that today's conversations give business leaders the tools to guide their organizations through these increasingly volatile times. So over the next hour and a half, Bloomberg journalists will moderate panels that tackle how leaders can meet the needs of their customers, employees, and investors in a volatile business environment, and really how companies can thrive in the face of all of that volatility. We'll also build on topics and themes that were discussed during the World Economic Forum in Davos just a few weeks ago. I'd like to take a moment to acknowledge our presenting sponsor, Accenture. And I'm going to be moderating our first panel. It's called Volatility and Resilience, the Call for Greater Agility. And let's begin with welcoming our panelists. Pierre Breber is the Chief Financial Officer at Chevron. Paul Lundstrom is CFO at Flex. And Anya Manuel is co-founder and partner of Rice, Hadley, Gates, and Manuel. And I just want to say thank you all for being with us. It's an incredible lineup, I feel like, to discuss all of the volatility and issues that are facing us. And so let's start there. Before we actually got started, Paul, you reminded me of just some comments that Jamie Dimon a week or so ago talked about, storm clouds and how that was complicating our outlook and our economic potential, if you will. And then just about a week later, he talks about we're now in a hurricane season. I mean, so much of what's going on right now is changing very fast. It's very fluid right in front of us. And a lot of this was brought up recently at Davos at the World Economic Forum. They talked about supply chains, global alliances, upended commodity and labor cycles, pricing distortions. We're still reeling from COVID. And then add on top of that, of course, the war in Ukraine. The volatility is chronic. So Anya, I want to start with you. And let's remind everybody, as we're having this discussion, the news flow is evolving and nonstop around us. Your firm, Anya, is all about helping companies navigate what's going on in the global markets. What kind of calls are you getting right now? And what are you telling them about today's situations?
Yeah, this is a stormy geopolitical environment. Thank you so much for having me, Carol. I think, let me just start with the two biggest geopolitical issues on everyone's mind. Russia, where Vladimir Putin is trying to reunify the Russian Empire. This is not about NATO expansion. It's about more than that for him. It's personal. And so unfortunately, in that big macro situation, which is roiling oil and gas markets, food supplies, everything we're going to talk about on this panel, I think what we see is most likely you're going to have a quagmire. We're all hoping and praying for the Ukrainian people who've been so courageous that they can push the Russians back out of Ukraine, but that's looking less and less likely. And as this war grinds on, you're going to see continued upending of supply chains. You're also going to see the continued pressure on these markets, and it'll be much harder. The West has shown remarkable unity, and businesses and government has shown remarkable unity. It's going to be harder and harder to keep that together.
Yeah, and we thought No, go ahead, please.
Yeah, and I'll just say one word about China. Often when you hear about China in the Western media, we act as if they're 10 feet tall. Their airports are gleaming and their roads are smooth and we can't get our act together. I don't think that's how it feels inside China right now. President Xi Jinping, as you know, is trying to go for an unprecedented third and maybe forever term this fall. But something funny has happened on the way to his coronation. The zero COVID policy has been a complete disaster, with growth actually turning negative in China this past April. Those numbers, as you know, are hard to believe, hard to know what the statistics coming out of there. And as a result of this economic crackdown, self-imposed recession in China, the political crackdown has been just extreme. It's harder and harder to have real conversations with the Chinese, and that is making the whole geopolitical environment much less stable for all of the companies that we work with here in the US.
Well, Paul, I want to bring you into this because you guys have had a presence in China for several decades. I'm sure you've had lots of conversations with the Chinese. What's interesting about you guys, too, is you got, I think, about 100 100 sites in some 30 countries. You touch just about every industry that is out there in the world, and you are dealing first and foremost with supply chains. How difficult is it to get things done? And what are some of your thoughts about what we just heard from Anya in terms of our macro setup?
Yeah, well, it certainly has been a dynamic couple of years. Just a quick background on Flex. I think it'll help you to understand the lens I'm looking at this through. Flex is a large, advanced, diversified manufacturing company. Like you said, we've got 100 facilities around the world, 100 plus, and operating in 30 different countries. So we see a lot of the market by market nuances. And what we've seen over the last few years for particularly a company that does large scale manufacturing like Flex is just disruptions all over the place. It started a few years back with trade disputes that quickly rolled into the pandemic. The whole world saw the shock and awe from the pandemic and the pandemic response. Pandemic, rolled into chip shortages, and now you have logistics issues, and who hasn't seen aerial photographs of miles and miles of container ships stacking up, off the coast of Long Beach? So it's been an extremely dynamic environment for all of us over the last few years. And what I'll say is that's essentially been one giant 2 or 3 year sales pitch for large scale diversified manufacturing companies that manage supply chain and logistics. And so we've had all sorts of inbound inquiries over the last couple of years on, hey, look, I know you guys are manufacturing for us in Asia. Can you repipe that supply chain to Europe or to the Americas and do more regional manufacturing? So one thing has led to another, and we're seeing some interesting trends for sure.
Well, it's interesting. You use the word dynamic. It almost sounds, and to be fair, the pandemic showed us that there were some big losers, but there were also some gainers, right? As the world kind of shifted and adapted. How easy, though, is it, Paul, if I may follow, in terms of shifting from China, we have a big presence, right? You've been there for a long time, to doing something in Europe. That stuff doesn't happen overnight, or does it?
Well, I wouldn't say it happens overnight, but there are a few large manufacturing companies in the world that have the scope and scale that a company like Flex has. So like I said, we're operating in 30 countries already. And so picking up and moving out of one into another on a small scale, piece of cake. We honestly, we do it all the time. On a larger scale, it's a little more difficult. It takes a little bit more investment, but you'd be surprised how many customers are asking us to do that. They want their end products built closer to their end markets. And so we're producing in Asia for Asia, in Europe for Europe, in the Americas for the Americas. I think it's a trend that we're going to continue to see.
All right, we're going to dig a little bit deeper because I want to get into kind of nearshoring, onshoring. Pierre, come on in on this, because again, as I said, winners and losers in any crisis. And we see that. And you and some of the other super major peers really have been among the biggest corporate winners coming out of the war in Ukraine, just because of the spike in oil prices. I know we talk about the equity trade every day, and certainly the big energy companies are among certainly the outperformers easily. Someone recently said on Bloomberg, though, every boom in the energy market is followed by a bust. And I spent times up in the Bakken where people, it's been a boom, and then people are like, yeah, but the cycle falls apart. So how do you look at this moment of volatility, and how do you think about strategy plays, longer term, short term right now?
Energy markets are in an upcycle. Demand is very strong. Supply is responding, but it's lagging. It's really the reverse of what happened 2 years ago, when demand decreased very quickly and sharply, and supply couldn't respond as fast. So there's a time lag, but the supply is responding. Clearly, the Russia-Ukraine conflict, and we want that conflict to end as soon as possible, has tightened, has strained already tight markets. But the commodity cycle was well underway before the Russia-Ukraine crisis. All that said, over time, as you said, we expect markets to rebalance. It is a cyclical business. As I said, supply is responding. There's a time lag, and Chevron's doing its part. Our capital expenditures are up 30% this year versus last year. Our U.S. oil and gas production was up 10% in the first quarter, and we raised the guidance for our Permian production to 15% annual growth this year.
So, Pierre, do you feel like you have, amid all the volatility, confidence to make? It sounds like you are doing the capital expenditures that you need to do, that you have enough visibility, even amid all of this turmoil and volatility, to make commitments, whether it's financial commitments or strategy commitments?
It's very consistent with our plan. We expected COVID to have impacts, but again, when times were tough, we thought the cycle would turn back. So it's within our guidance. It's actually still at the low end of our guidance. So you'll see continued capital increases. We talk about three characteristics very close to the ones you had in your intro, Carol, that have served us well for years and will serve us in the future. First is to be consistent. During crisis like we saw in COVID, particularly our shareholders, and Paul's one of them on this call, they count on the dividend and they need to know what they can count on in a crisis. And so we were consistent in maintaining and growing the dividend through a crisis. The second is be prepared. We had a pandemic playbook. It wasn't exactly for COVID, but it gave us a head start. We have a playbook on how to deal when prices crash almost overnight. We've seen that in 08, 09. We saw that in 14, 15. So we know what to do. And the third is to be adaptive. And to your point around confidence, we were the first company in the industry to announce a major acquisition in July 2020, a few months after oil prices famously went negative. And then we've made a lot of progress on our lower carbon strategy, and we look forward to closing another major acquisition of Renewable Energy Group later this month.
Is it a reminder, Pierre, that in crisis, there are opportunities?
Absolutely. It's the old saying, never waste a crisis. We're a much better company than we were 2 years ago. We're more capital efficient, we're more cost efficient. And as I said, we're making great progress on our lower carbon strategy.
Anya, come back in on this because I am curious about the conversations you guys are having with your clients, right? About some of the trends that we are seeing. And I think the longer this war, I think there were many initially thought it would be over soon. Well, obviously here we are and it continues on. What's the advice that you're giving to some of your clients that you were talking about what it means to be agile? What kind of methodologies do they need to be enacting?
Yeah, agile and resilient are the watchwords. We, Condoleezza Rice, my other business partners, and I advise US CEOs on geopolitics. And so it's been an exciting few months. And I think the good lesson that most of the CEOs we work with have taken away is they were a little bit blindsided. They didn't quite see Russia coming. I think there's an untold story here that US businesses reacted so well. I mean, really had their values out front, did what they could for their own employees in Russia, in Ukraine, went well beyond what the sanctions required and really found their values as corporations. And that's a really good story. And now what we're doing with a lot of our clients as a follow-up is saying, okay, so we did that in Russia. Russia was a tiny amount, usually, of US companies' revenue, but China is a huge chunk of their revenue and the supply chains run through there, everything that Paul was talking about. So now we're doing a lot of conversations. How do you make that part of your business more resilient? How do you think about diversifying and having a pan-Asia strategy, exactly what Paul talked about, rather than just a China strategy? How careful do you have to be about R&D in China, where it's inexpensive and they have great engineers, but spies are likely already in your system? And a whole list of things running through indicators. What are the break glass things that could happen in US-China relations that would really make you have to rethink as a CEO, whether you need to make sure your expats are safe, whether you need to move your operations out of there, or whether you can continue to do business?
Well, and, Paul, come on back in on this, because I do think if for anybody who's out there, this concept of nearshoring or onshoring, is something changing when it comes to globalization, which we know has benefited so many globally. And many would say it's hard to go back on this, but how do we need to, is there going to be something different going forward about more nearshoring and onshoring?
Well, I think it has changed, and it hasn't just been the last couple of years. It's been for, I don't know, at least at Flex, it's been for 15 years. You look back 30 years ago, and it was, manufacturing was all about labor arbitrage, and so you saw a lot of work, moving overseas to take advantage of lower labor rates. Interesting stats here. This is just for Flex, but 15 years ago, 56% of our sales came out of Asia. So it was for export, but it was produced in Asia, 56% of the business. Last year, 37. So over the last 15 years, you've seen about a 20-point drop in production in Asia. Now, does that mean that we're exiting, Asia? No, absolutely not. I mentioned before, we're going to produce in Asia for Asia. We're going to produce in Europe for Europe. We're going to produce in the Americas for the Americas. And there's going to be export out of all of those regions as well. But I think that's just as the supply chains have grown more and more sophisticated, as end customers want their product closer to the end customer, we've just been repiping the network.
So Pierre, you know what I was thinking too? You've been at Chevron for a long time, and I feel this way when we talk about the financial markets. I do like talking with folks who've seen a lot of different market cycles. Not every market up and down is the same, and we know that. And I've heard a lot of folks talking about this is different this time around, and we talk about it certainly from a Fed balance sheet perspective, going from an economy that dropped like a rock to bouncing back like a ball. How do you think about this current cycle? As you said, there's boom and bust certainly in the energy market. How do you think about this one? Is there something different that is shaping strategy or some of the conversations that you're having with your CEO, Mike Wirth?
All cycles have similarities, fundamentally demand and supply getting out of sync because again, they operate on different time cycles. And yeah, they all have differences. If you go 08, 09, global financial crisis, 14, 15, largely specific to the industry and supply responding, and then COVID. So what does feel different about this one clearly is ESG and the, we have been an out of favor investment for a long time. I know the energy sector has performed well for the last year, but if you go back 10 years, and for most of the last decade, we've been a flat stock with a growing dividend, but a flat stock in a market that's tripled. And if you go back 5 years, the market's doubled. And again, we were flat till very recently. So we still have a long way to go to win back investors. But what we're seeing is clearly the constraints on capital investment is a difference. ESG investing is a much bigger trend than it was, the last couple of crises that we've had. You have European companies under a lot of pressure to shrink their business. We have not. We intend to grow our traditional business and our new energy business. We think we can do both, and we know we can do both. But we have some major competitors that are shrinking, getting out of the business essentially. You have Saudi Aramco, which is a public company. So yeah, there's always some differences, and it might cause this cycle to stay up longer. But fundamentally, it's a cyclical business. We're prepared for a correction. We show our investors what we call downside resilience, upside leverage. So we at $50 Brent, so less than half of where we're trading right now in oil prices, we can invest in the business, we can grow the business, we can grow the dividend, and have a strong balance sheet. And of course, at prices above that, we'll generate excess free cash flow and we can buy back a lot of shares. So when oil prices were negative, we knew it wasn't going to last forever. When oil prices over $100, we know that's not going to last forever either.
When you said ESG, because this is one of the other things that people are concerned about, that because of the pressures on the system right now, especially in the energy markets, that it will slow the transition to alt energy. Being agile in this volatile market, you have to still continue to think about kind of where this world is going. Is that fair to say, Pierre? And you have to continue to make those investments.
Both things are true. So the world's going from 7.5 billion people to 9 billion people. Billions of people around the world want greater access to energy. And of course, the world wants to address climate change in the Paris agreements and want lower carbon sources of energy. So we can do both, and we are doing both. And you see that in the growing production we talked about earlier this year, and our renewable energy group acquisition, which we'll do in June. We'll be the largest biodiesel producer in the country. We're going to grow renewable diesel. Like Paul has customers who want shorter supply chains, we have customers who want lower carbon solutions. So United Airlines wants lower carbon jet fuel. Amazon and Walmart for their trucking fleet, they want lower carbon fuels, renewable natural gas, renewable diesel, conventional diesel that's made with lower carbon, hydrogen one day. And so our new energy business, which is focused on renewable fuels, hydrogen, carbon capture and storage, is making great progress, but it is a long transition. It's decades. We talked about the chip shortage takes a long time. Transitioning such a massive system like the energy system or the food system or other systems, it is going to take decades.
I want to get into specifics if I can. And Paul, let me jump in with you because we said, what are the operational financial agility that's been necessary to anticipate and respond to unforeseen challenges? Could you be specific? Because I do think about the audience that's out there that's listening to you guys who are front and center, have front row seats to really some of the key challenges today. So what are the specifics when it comes to operational financial agility that you've had to take to anticipate some of these unforeseen challenges?
Let me, it's a great question. Let me give you a very specific example that goes back to the immediate, fallout from the pandemic in spring of 2020. Two very different businesses within our portfolio. We've got an automotive business, and then we have a health solutions business. In the automotive business, that first quarter after the pandemic really got crazy worldwide. So that April to June quarter, we saw the automotive business within Flex drop about 50%, 55-0. And so the effect on a large manufacturing operation is significant. You gotta tighten the belts. You take cost out. You have to be ready to respond when it comes back, but you have to just protect the business. So that as a bookend, massive crisis, huge volume reduction. On the other end of the spectrum, we were asked to start producing ventilators in response to the pandemic. And we had never produced them before. And so over about a 6-week period, we did a rapid ramp program. And by the end of the 6th week, we were producing patient-ready ventilators. And Flex became, in 2020, the largest non-captive ventilator producer in the world. We made like 50,000 of those things in 2020. Two very different business responses. And you have to be agile from a financial perspective, from a modeling perspective, as you're thinking through your business continuity plans. On the automotive side, it was, all right, look, we gotta tighten things up. On the health solutions side, it was, hey, we gotta invest fast. We have to be fleet of foot. We have to have the engineering talent in place. We have to have the production readiness in place. And we
How were you able to do it though? Did you have the money, the people?
I would say a flexible management team who saw the opportunity, understood the necessity of the quick response, and poured the resources into it to make it happen.
Anya, come on in too about specifics in terms of, do you tell some of your clients, like, make sure you have this in place? Or, it's interesting, coming off of the financial crisis, I feel like CFOs became king because they kept companies alive. And we're constantly looking at the balance sheet and what had to do in a market where everything just seized up. And so I do think about the conversations that the CFO now has strategically with the CEO. You guys can tell me. I mean, it's much more, you guys just are on it. So Anya, I'm just curious, when you are talking with companies, are you saying, here's what you guys need to make sure that you have in place?
Yeah, absolutely. And I think the CFOs have become kings, but so have the CEOs. They're starting to earn their very high salaries because it's just a much more complex environment than before. And in addition to being nimble, as Paul and Pierre just pointed out, the ESG overlay and the values overlay has never been stronger. So a lot of our clients used to say, well, we're American headquartered, but we're really a multinational and we see ourselves as global. That's going to be harder and harder. I don't think that's going away. The pendulum is swinging back somewhat, not entirely, from globalization. So it's impossible now to say one thing in China and another thing in the United States. And in the United States, CEOs are being asked very clearly to ensure that they're not transferring sensitive technology that could help the Chinese military or human rights abuses. They're being asked to ensure that they're following the highest environmental and human rights standards. Pierre made that point earlier. I'm just off a board meeting yesterday, transportation company. We're not slowing down in our environmental. And I don't see a lot of other people either. Maybe there's a blip because of this very high oil price just now, but that's also an opportunity, exactly as Pierre said, because it makes all of those alternative fuels that are just coming onto the market more market ready. It gives them a little bit of a bump. And so I think these trends are big and they're going to continue. And the final one, I would say, whether there's going to be a Democrat or a Republican in the White House, the projects supporting US jobs is going to continue to be important. And Paul talked a lot about diversifying all over the world. I mean, Flex is one of the best companies in the world at this. A lot of the reshoring I've seen hasn't come back to the United States. The big beneficiaries, frankly, have been Mexico, Malaysia, a couple of other Southeast Asian countries. So that's not happening. But thinking about how, as a CEO, you're impacting US jobs is going to continue to be critical.
And Pierre, I want to go back to you. I know I asked, Paul for specifically, what operational financial agility has been necessary to anticipate and respond to unforeseen challenges. I'm reading the question because I do think about our audience who are like, okay, what do I need to do? What would be one that you would say?
We follow our 4 financial priorities, which we've had for a long time, and they really serve us well in a crisis. And the first is to maintain and grow the dividend. I talked about that.
Right.
The second is to invest in the business. We made significant capital reductions when COVID hit, but we reduced short-term supply. but we kept investments for long-term supply. And again, we announced a major acquisition. The third was to maintain a strong balance sheet. And the fourth is we have excess cash, we buy back shares. And clearly we suspended share buybacks in 2020 when COVID hit, and we've resumed them since. So having a real clear sense of priorities. Again, I called the prior CFO who lived through 14, 15. I called the CFO 2 times ago, who lived through 08, 09. So we have playbooks. Again, we're prepared for this type of crisis, and we know what to do. In terms of the energy flows changing, we will see more U.S. energy flowing to Europe. Russia is a very large energy producer, and they've been exporting to Europe. U.S. natural gas is something that you'll increasingly see go to Europe. U.S. crude oil, refined products even. It takes time to reroute energy flows, and it'll add some cost, but that's underway. So it's a very dynamic world. We've learned to be adaptive to it, and having very clear financial priorities that that are tried and true, that have been tested during a crisis, and then executing against them.
How do you all think about the global alliances going forward? I mean, Antony Blinken, U.S. Secretary of State, recently saying the U.S. will seek to influence China's behavior by shaping the world around Beijing. China says it will work with Russia to promote real democracy. We saw in terms of the energy market, OPEC producing more. There's talk, about President Biden going over to the Saudis and meeting with the leader there who he has been shunning because of the murder of the journalist a few years ago, Khashoggi. So I just do wonder, how do you guys rethink some of the global alliances that are out there, Paul, and maybe that are going to stay with us much longer, or maybe it's just a new paradigm?
Yeah, I certainly hope for unity. I think, like everyone else, I think I had mentioned before, I don't think.
What does unity look like? What does unity look like going forward?
Free global trade, no protectionism, and again, it's the interconnectedness amongst all the different countries around the world is incredible. I don't think people realize just how tied in together we all really are. And so the antagonism and the saber rattling and the us versus them and them versus us, it's just bad for the global economy. And I really believe that. We really are incredibly interconnected. Look at Ukraine, perfect example.
Right.
I didn't realize this, but 20% of the high grade wheat comes from of the world's high grade wheat comes from Ukraine. Are you kidding me? It's a small GDP country. It's 100 times smaller than China if you look at GDP. Yet they produce 20% of the world's supply of high grade wheat. We are really interconnected. And if you start being obstructionist and you put up these big trade barriers, it's just bad for everyone. It's like economics 101.
Anya, how do you think about global alliances? And you gave a TED talk a little while ago and saying the West's real competition is the Communist Party of China. And you talked about China extracting technology from the West through both legal and nefarious means. China has definitely ramped up its efforts since then. It's very clear about their plan for the country. So how do you think about global alliances that's going to be impacting the global corporate world?
Yeah, 2 points. That TED talk was actually specifically on technology. I do not think the US and Chinese economies should decouple as a whole. I think that's damaging. I agree with Paul that actually free trade helps lift all boats. However, it's not the political environment we're in, and I don't think we're going to be there for the next 5 to 10 years. Just like you saw America first here, you have populist movements all over the world. Brazil first, Turkey first, Hungary first, India first. So I think you're going to see a wave of not total protectionism, but more what Janet Yellen calls friendshoring. Mm-hmm. And so this gets to your point of alliances, Carol. I think Vladimir Putin did the West a favor by wiping out that tyranny of petty differences. I'm in Europe all the time talking with senior policymakers. 2 years ago, you couldn't get them to think about China in a strategic way. Now they're all thinking about China. And they're increasingly worried about some of the ways, not all of the ways, that China shows up in their system. So from a political perspective, I think you're seeing an era where you're going to have imperfect alliances, not blocks like you had with the USSR and the US in the Cold War, but areas of comedy. So you're seeing the Quad develop into something much stronger than it was originally anticipated. South Korea now saying they want to join in with the Quad conversations about how do we actually maybe not build all the semiconductors here in the US, but how do we do it with our friends and allies? And that's the big democracies, developed economies in Asia. So Japan, Taiwan, increasingly, South Korea, the US, Australia, New Zealand, India to some extent, and then the US and Europe. And I think that is a trend that is with us for a long time, and companies are starting to adapt.
I just want to wrap up real quickly, go round, Rob and Pierre. Just final thoughts and thinking about this audience that's listening. I'm assuming you think volatility will continue, or do you think we'll kind of calm down?
It'll continue. Again, be consistent, prepared, and adaptive, and be ready for the good times and be ready for the tough times.
All right, got to be flexible. Paul, final thoughts?
Yep, spot on. I agree with Pierre. Unfortunately, I think this chaos is our new reality. I think we just have to ask ourselves what's next and start planning today for whatever possible scenarios could present themselves. From a CFO perspective, we need to protect the business in the short term, but continue to make the right strategic bets and investments for the long term. And part of that is expecting the unexpected and having the discipline to model a very wide range of possibilities.
Yeah, you got to be on your toes. Anya, final thoughts.
Yeah, we're moving from a just-in-time world to a resilient world. It may be slightly less efficient, but ultimately it will make us all stronger.
All right, gonna leave it there. Anya, Paul, Pierre, thank you so much. Really appreciate it.
Thanks for having us.
Thank you.
Hello, I'm Meg Szabo, Senior Editor of Bloomberg Green and Sustainability Events, and I'm happy to be moderating our second panel, The Green Bottom Line, Measuring Sustainability to Drive Impact and Value. I'd like to welcome our panelists for this discussion: Daniel Clear, CEO of ESG Book; Zoe Knight, Managing Director and Group Head of the Center of Sustainable Finance at HSBC; and Brad Sparks, Executive Director, Accounting for Sustainability Project A4S. Brad, I'd like to start with you. We have been living in a world of acronyms here in sustainability: SASB, TCFD, and now ISSB. As someone who works with hundreds of CFOs and finance teams, what is your take on the evolution of reporting structures across different sectors and industries? Do you think the ISSB's global standardization efforts will take disclosures to the next level?
Great. Well, Meg, first, thank you for having me today. And certainly there are quite a few acronyms that people are trying to navigate and understand. You know, at A4S, what we've been doing over the last 12 months is convening more than 200 CFOs, chief accounting officers, controllers, in a series of roundtable discussions to talk specifically about the evolving reporting landscape. And from that community, there's overwhelming support for alignment and harmonization of standards that can produce globally consistent, comparable sustainability information. The IFRS Foundation, which now has established the ISSB, are really very well suited to lead this next evolution in reporting for several reasons. First, because of their role in the financial reporting arena already, they can really accelerate the adoption of global sustainability reporting standards, in particular where it relates to investor-focused needs. Second, the ISSB is going to be closely cooperating with the International Accounting Standards Board, the IASB, which sets accounting standards, and having that connection and connectivity will be essential to really connecting sustainability with financial performance. And then finally, the ISSB, is really well suited to establish a global baseline for sustainability reporting that can underpin the building blocks that are needed for standards and set the global baseline that's needed. And that's where there's a real concern, is the potential for fragmentation, where you have different approaches coming that make it difficult for CFOs and preparers to respond in an efficient and effective manner. So yes, ultimately, I think the IFRS can help in this regard.
Great. And along those lines, Zoe, I know that you have been a long-time supporter of both TCFD and now GFANZ and along with other initiatives. Can you just share a bit about some of the external initiatives that you are involved with and HSBC is involved with?
Yeah, for sure, Meg. And echoing Brad, thanks for inviting me to join you today. So HSBC is a keen supporter of external coalitions that are driving common ground across the ESG arena. Now, we know that we don't want fragmentation because we all want to be generating the end result. So HSBC is a strong supporter of GFANZ, the Glasgow Financial Alliance for Net Zero, because we know we need that common voice. HSBC is leading the Transition Plan for Financial Institutions working group that aims to really set out the ingredients for a strong transition plan for the financial sector. Now, that plan is going to take several components to generate. It's going to be all about organizational structure, client engagement, using the data to be able to set metrics and targets, and having an overarching governance structure that demonstrates that the whole thing is going to be implemented effectively. So we're hugely reliant on the work that my fellow panelists, Brad and Daniel, are doing in the ESG space to make that really happen effectively.
Great. That's wonderful. And just to be clear too, TCFD and GFANZ are also Bloomberg initiatives here. So we're very proud of those. So Daniel, to you, I know, at your role at ESG Book, you have been working to try and solve the sustainability data problem and some of these standardization issues. Can you share a little bit about the tools that you've been developing and how potentially a CFO or maybe a CSO could use them?
Yeah, thank you. And thank you for having me on the panel today. So I spent my last 10 years at HSBC, so worked very closely with Zoe, and I found myself sitting on panels almost every week complaining about the lack of data. And so I moved over to ESG Book about a year ago to solve that problem. And for me, I have 3 observations since then. First of all, our problem actually isn't the lack of data. Our problem is there's too much data. Right? We live in a world where we have too much non-financial data. And what we really need to do is help CFOs and chief sustainability officers and boards and CEOs to make sense of that data. Second, the only way to do this is to combine structured and unstructured data. My favorite example is always, if you want to know the GDP of China, you don't wait for China to tell you. You count the number of containers in the port of Shanghai and the light emitted by Chinese cities. And the same way we can deal with sustainability issues if you combine structured data, so what companies disclose, and unstructured data, anything that we know about a company in the world, media, social media, NGO data, satellite data, we know so much more than we think. And finally, one of our problems in the ESG space at the moment is we treat it as a black box. And that creates a lack of trust, lack of transparency. And I think one of the big jobs for us is to uncover the drivers of sustainability and take apart what is climate, what is human rights, what is diversity and inclusion, and actually go down to the substance. And so what we created is a platform, ESG Book. I have about 10,000 users on the platform at the moment. And what you can do on the platform is explore the data for about 97% of global market cap, 25,000 companies, and go down into every single data point, about 450 data points for every company in the world. Because I think what investors and companies want these days is transparency of what actually is driving sustainability performance, not just a headline number.
Yeah, that's amazing. And that's a lot of data. How do you work to kind of select what those data points are?
So we combine 2 things. We have a very traditional approach. We have a large team in Delhi. We collect and curate data that companies publish about themselves. But then we use technology with AI, with natural language processing. We read about 30,000 news sources every day. And you recognize patterns, right? Is there a human rights violation? Is it recognized in the press and in social media once, twice, 10 times? Different sources recurring. And with that, you build patterns that actually can recognize what is happening. And the beauty of this approach is you combine something that is often backward looking, like what companies tell you is important, but it is always backward looking. What the world says about a company is normally forward looking and gives you an indication of where's a possible risk, where's somebody not on track. Because if I look at the questions that I get from my clients at the moment, and that's mostly large investors in the world, is how reliable is a target? Can I trust the target? And especially when we come to climate targets, people want to know, is this just marketing or is this actually being delivered? And so you need something that is more forward looking. Otherwise, we always look in the rear mirror.
And so since you are looking at all these data, and I did just kind of ask Zoe and Brad a little bit about, ISSB, TCFD, GFANZ, do you find that those initiatives are helping what you're working on at ESG Book?
So my attitude is the more material you give me, the better, right? And regulation is one very, very important driver to bring more substance into the public debate. We have a problem that at the moment there are probably too many initiatives, but regardless of that, I would say the more data we have, the better. What is missing at the moment, and I think that's where obviously the ISSB work will be very important, is to make these initiatives substantive. TCFD is a wonderful initiative, but we now need to make it mandatory and we need to make it specific, because at the moment I open the TCFD reports of two different companies in the same industry and I get very different insights. And I think we all know that financial markets are very clever. If you give financial markets signals, they will incorporate the signals into capital allocation. But these signals need to be comparable and consistent. And so I think over the last 5 years, we've built an incredible amount of attention and capacity in the industry to think about these topics. We now need to standardize it and give the data to investors to actually allocate capital in the right way.
Yeah, absolutely. So Zoe, talking about that, I'm kind of moving to the financial side. HSBC has set out sustainable financing targets up to $1 trillion by the end of this decade. How is that going? And can you talk a little bit about how you're measuring that progress as well?
Yeah, thanks, Meg. But just before I do, though, I'm going to pick up on a couple of points that Daniel made just to reinforce the importance of them. So this transparency piece is really critical because we need to now move from the commitment stage of climate to the actual implementation and evidence side that finance is actually flowing in a way that supports emissions outcomes. And so that's what we were trying to do with the bank when we set out our net zero ambition goal a couple of years ago. As part of that, we set these targets, as you mentioned, up to $1 trillion over the next decade or so. And we're well over 100 billion of the way there so far. But we need to do more and we need to move faster. And this point about substance in terms of how we translate the raw message of the data into an outcome is something that both GFANS and TCFD look at. So if you think of phase one of climate assessment within financial organizations, it was all about the risk categorization. Now we're being asked much more frequently to talk about alignment of capital to emissions outcomes. We know what the pure play solutions are for climate. We know that we need to scale up power provision from renewable sources. We know that we need to scale down some of the most fossil fuel polluting sources of power. But what's really tricky right now is figuring out how to move forward in steel in a fast way, in cement in a fast way, shipping, aviation, all of those sectors that are critical to the real economy and how we operate today, but that we need to shift into cleaner forms of operation. So those financing goals really provide a signal of seriousness of intent, but they also need to move faster, and we need to unblock the barriers that will be helped by both policy implementation, but also by this move that we're talking about around effective use of data and how we move that forward.
That's amazing. Yeah, and you're right. I think that's the hardest sectors are the ones that we really need to be focused on. Brad, Daniel, I'd love to also get your take on the success metrics that matter. So Brad, maybe to you, what are you seeing as the top KPIs that financial leaders in the markets are interested in right now?
Yeah, I mean, I think it's a range and it varies by sector, but I think what we see across multiple sectors is that CFOs are getting much more engaged in the development of KPIs. And when we think about consistent and comparable information, we really need to think about reliable information as well. So what CFOs today are doing are saying, okay, do we have a robust control environment will actually provide reliable data that we can use to track our progress? And then how are we integrating that into decisions across the organization? How are we maybe integrating that within executive compensation plans and getting, again, reliable, consistent information in a timely manner that will help meet those needs? So that's where I see really today's CFOs playing a key role in the development and establishment of sustainability-related KPIs.
Great. Daniel, anything to add there?
Yeah, maybe just three very quick observations. I think my co-panelist mentioned them. First of all, there's a clear shift from commitment to delivery. I think we're past the point where people need to make new commitments. It's all about showing progress. And that is the most critical thing for this year. We have a COP coming up in Sharm el-Sheikh. It's all about measuring progress. And frankly, there isn't a lot of good data out there yet that moves from what people have committed to especially under G funds in Glasgow to actually progress measurement. The second thing is, I think we are moving to a world that is more granular. So we're no longer in a world where we discuss brown and green. I think we all know that the world is a shade of olives. But to measure a shade of olives, we need to be more granular in how we think about different transition pathways. And the third, we're moving from exclusionary strategies to transition strategies. All three things have in common that we need to provide more transparency. And I think when you open the newspapers at the moment, the word greenwashing is on every page. And the only way to fight greenwashing is radical transparency to build that level of trust.
Absolutely. I think we are all, the transparency is our number one issue. And I think we just hear it time and again. Moving to Davos, since that was just last week, and I think obviously decarbonization and climate took a center stage there and brought a slew of new pledges to your point, rather than trying to take care of the ones that we have already made. I'm curious about your takeaways from this meeting, from both business and political leaders, particularly as it relates to who is driving accountability and this transparency and standardization. Is regulation potentially one of the answers here? And I think let's start with you, Zoe.
Yeah, I mean, for sure, we really need to get more granular on the implementation point and this proof that, the science that was set out for us earlier on this year by the Intergovernmental Panel on Climate Change really pointed towards this repeated urgency of getting emissions down. And what we need to do now is move forward from Davos into COP27 and COP28 and really demonstrate radical collaboration that is going to unblock barriers. And what I mean by that is we can't keep having a conversation where you need demands to take effect so that supply will come on stream. We've got to get through that by saying, right, how do we commercialize these markets? How do we commercialize green hydrogen? How do we make it sensible for carbon capture and storage to be attached to certain activities? But at the same time, we need to be really transparent, going back to the transparency point, about scientific alignment. Is this investment today really going to generate a 1.5 degree world in the future? Or is it taking us on a lock-in infrastructure pathway whereby we're stuck and we blow through the carbon budget in the next 2 years instead of the next 8, 10, 15, 20 years further down the line? So there's a lot of work to do, and it is really that radical transparency, radical collaboration, radical cooperation across different parts of society to really make this happen.
Yeah, absolutely. And Daniel, anything that you would want to add to that?
Yeah, I think on this topic, there is no silver bullet. The only way to achieve it is an interplay of regulators, investors, and companies and customers, therefore, because actually pushing sustainability in a supply chain is often the most effective, because if a customer says, I will no longer buy from you, is even more effective than great investor engagement. So I think there's no silver bullet. All three initiatives need to work together, customers, investors, and regulators. But what's important that we start to align this more. And therefore, I mean, my co-panelist said that what's happening with the ISSB is being very closely watched, because that is the hopeful trigger to more consistent information.
Absolutely. Yeah, and I agree. I'm completely on that. Anybody have any thoughts on, what else regulators can maybe do to help encourage better implementation of the measurement and the tracking? Daniel,
well, I give you one thing. We need to find a way to avoid the regional adoptions. Right? People may like or may not like the EU taxonomy. A lot of work has gone into it, and it's probably the best thing we have at the moment on it. But we now get 35 different shades of the taxonomy. And I think we see the same with securities commissions. We see similar things with central banks, although they are a little bit better coordinated. I think it is critical that we find a common language. If you speak to CFOs today, and Brad, I think, can confirm this, they're all frustrated because they get 30 different questionnaires. And that's not the way to drive sustainability.
Yeah, absolutely.
Yeah, just to add, I mean, I think, yeah, that drive for, both an effective and efficient corporate reporting system is what we need. And what we're doing, right now is really encouraging the CFOs and other preparers in our networks to make sure they actively engage in the ongoing consultations. So these are still open. There's consultations out there. Chime in and share your opinion and voice.
Great. And then Brad, to you too, as talking about CFOs, excuse me, and that increased focus on ESG for them, and broadening that role a little bit. They do really need to be familiar with these topics now and the metrics, and be able to communicate those to shareholders who are demanding, this transparency that we're talking about. What are the main areas that a CFO you think should be focused on when it comes to a company's sustainability strategy?
Yeah, a few different aspects. First is, CFOs should really recognize that there's, an essential responsibility and essential opportunity to get much more engaged with the company's sustainability strategy, because they're really the right people that are able to enable that. That role goes much deeper than just reporting. It's actually embedding relevant social and environmental factors into management information frameworks and the decision-making framework, and it's actually using it to help make corporate decisions. So that's first. The second aspect I would say is that CFOs should recognize that sustainability connects across the finance organization. So that may be treasury and investor relations, thinking about sustainability linked financing, internal audit, thinking about sustainability as part of the risk register, the controllership, thinking about that control environment for sustainability. Data really cuts across the finance organization when they should be thinking about this. And then they should be speaking regularly with the board, and in particular the audit committee, about the organization's sustainability reporting approach and performance. My last thought is, sustainability integration within the finance department is really a greenfield opportunity for CFOs, and those that really recognize this can actually do something that's legacy defining if they think about how they can transform the company's systems and operations.
Amazing. And what would be like maybe one top piece of advice you would give to a CFO on how they could start to integrate sustainability into their reporting?
Yeah, the one thing we're seeing right now is the establishment of these ESG controller roles, which I think is really interesting. So when you think about the finance organization and where that should sit, these new ESG or sustainability controllers are starting to take shape, and that can really drive change.
Great. Daniel or Zoe, anything you'd like to add potentially on the reporting piece for CFOs? Daniel, over to you first.
Yeah, I think there are a few things here. The first one, this is a data problem. This is not a topic that should sit in communications or marketing, where it still often sits. So this is the responsibility of the CFO. Second, non-financial data should sit right next to financial data. So when you give your monthly and quarterly financial report to the board, there should be next to it a non-financial report. And then third, I wouldn't worry about what the right standard is. Is it SASB, GRI, the different rating agencies? It is important to find the topics that are material for the organization and that will drive the right engagement with investors, because every organization has very different sustainability topics. So the materiality for the business and therefore the financial materiality is critical. So there's a risk of being confused by all these acronyms. In the end, this is common sense getting down to what drives the non-financial and therefore financial performance of a company.
Zoe, anything to add to that? Yep, so go ahead.
Yeah, just one thing on the materiality point, because again, this is how ESG has evolved. It's by taking materiality into account. And if you're the CFO, you need to worry about whether or not your business is high climate impact, and if so, how to address that. In terms of whether or not profitability is going to be impacted, whether or not growth is going to be impacted by that climate impact. And equally, are you going to be able to deliver your products in the future, or are consumer preferences going to change? Are your end markets going to start demanding different products, and are you ready and anticipating that? So the materiality threshold question is again a really crucial one, alongside the transparency thinking and the alignment to a downward emissions curve thinking.
Great. Yeah, absolutely. So we're just about out of time. I would always like to try and end on a positive note if we can. So a question to each of you, and Zodi, we'll start with you. What are kind of the areas of growth that you're most interested in right now, most excited about? What do you think maybe where we have the most opportunities?
Okay, so the science is really telling us loud and clear that we need to do more on renewable power, for sure. We need to electrify as much as we can. So transmission mechanisms, infrastructure, power decarbonisation is just one massive investment opportunity, as are the other areas like hydrogen, carbon capture and storage utilisation, and those topics that really will deliver a net zero world.
Great. Daniel?
I mean, I would love to be optimistic, but I want to say I think we're entering a very, very challenging period. Right? This year, we'll have a lot of criticism around greenwashing. We have suddenly quite competing priorities, especially when we think about energy security. And frankly, this year, ESG funds and products will underperform, let's say, more conventional markets, especially markets that have an exposure to fossil fuels. So I think it is very, very critical that this year we just stay course. We don't get distracted because we suddenly have competing priorities that may make this debate a lot more difficult. So I think really, really important this year to focus on continued progress on promises. Otherwise, I think we'll have a very different debate soon.
Yeah, I agree with that. Brad?
Yeah, definitely a challenging period. But what excites me, though, is that we're seeing the level of interest in finance and accounting communities getting involved in sustainability at unprecedented levels. And so we look at things like our A4S Academy, where we've had 300 finance leaders participate in it. And I think the finance and accounting community getting more engaged in this will help us address some of these challenges that Daniel was referencing before.
Yes, absolutely. Well, we will end it there. Thank you all so much for your time today. Really appreciate it. Thank you for joining us.
Thank you.
Hello, I'm Tom Metcalf, a finance journalist with Bloomberg, and I'm delighted to be moderating our third and final panel, Need for Speed, Technology as an Enabler of Compressed Transformation. Thank you very much for being with us today. So this is obviously a vast topic, and for those of you at the World Economic Forum in Davos last month, you'll know that tech and innovation was one of the recurrent themes there. There were sessions on crises, experimentation and innovation, the digital economy, and how all this ties in with inflation. And this idea of compressed transformation is really fundamental to all of this. And for those of you looking for a definition, basically it is this idea that all businesses now are really in a world where they need to move faster than ever before if they are to succeed. So it's clearly something that all executives at all companies are going to have to be wrestling with. And I'm delighted to welcome our panelists for this discussion. So they are Casey McClure, the CFO of Accenture, and Cynthia Chu, the CFO of Audible. So without further ado, let's get started. And Casey, I wanted to turn to you first to really set the scene for our audience. So why for you is this idea of compressed transformation such a critical concept in today's world?
Well, first of all, thanks, Tom, for inviting me to this panel. And it's great to have an opportunity to speak with you as well, Cynthia. And I think there's really, if you look at the technology backdrop, I would say there's really three things as it relates to what's happening in tech transformation. So first start with what companies have done over the last 2.5 years in this unprecedented disruptive environment. Companies that have done well have leveraged technology to transform their enterprise, often through the use of compressed transformation. And just to build on your intro and what you talked about in terms of compressed transformation, the way we think of compressed transformation, it's simply saying it's translating technology, data, and AI into value. Okay, so we obviously all want to do that. But it's also then doing it at speed and oftentimes with multiple transformations happening at the same time, where traditionally a lot of times that would be sequential. So that's the compressed transformation as we define it. And the exponential pace of technology innovation is here to stay. It's going to continue, which is rather exciting because it opens up probably an unprecedented period of change and positive momentum forward than we've ever seen. So it's a bit of the technology backdrop. And if I think about what you're talking about at Davos and everything that's being discussed as it relates to the macro, why is this compressed transformation important? Even with the discussion of inflation and recession, technology spend as a percentage of GDP right now is about 5%. And the view is that it will go to 7% by 2030. So it's a big increase in GDP. And in these times of disruption and uncertainty, IT spend is even more important because it really empowers the business to be able to have access to data and real-time analytics. And I know Cynthia's going to talk a lot about that, about the COVID. We have had our experiences, all of us in the last 2.5 years of pandemic. You have to move with agility, and you have to be able to go rapidly during periods of uncertainty. And maybe I'll bring it home in just a study that we did and we released at Davos that Accenture did. What we found out is that because of the pandemic and also Russia's invasion of Ukraine, there's a massive impact on your European supply chain. In fact, it's going to take 2 years for that to correct. No company has 2 years for their supply chain to sort itself out. So you really need to have data and information to be able to predict and plan and meet your customers' needs, right? So that really, without that data and without that real-time information, you can't shift to the demand, capture the growth, and get what was most important to all of us, meet or exceed your clients' expectations. And then lastly, Tom, I would say in terms of why it's so important is, it's all about performance and expectations of business performance. So interestingly enough, we did research before the pandemic in 2019. And what we showed was that the leaders in digital adoption, if you were in the top 10%, you perform better, 2 times better than what we call the laggards in technology digital adoption in the bottom 25%, the bottom quartile. We did that after we did that same survey after the pandemic hit, and what we saw is that 2 times gap widened to 5 times, right? So it really does pay off in times of disruption or uncertainty in the business to continue to invest in technology even faster than you've done in the past, because it will prove to yield business dividends.
Yeah, that's quite the change from 2x to 5x. So, and Cynthia, maybe now's a good time you'd love to hear a case study. So, CFO of Audible, I understand something pretty dramatic happened to your company in the pandemic, and you really had to pivot.
Absolutely, and what Casey mentioned about data, technology, and algorithm, all of those going at the same speed, we at Audible definitely saw all of that coming to life during the pandemic, definitely in the last couple of years. A couple of our people principle, move fast to make things real, and studying and drawing from technology and culture really help us focus on how do we bring these value to life for our customers. I'll talk about a few things, right? For Audible, being a digital audio media company, commuting and traveling were the top 2 use cases for us. And obviously with the pandemic and the lockdown, those 2 overnight essentially were gone. And so that customer behavioral change and the macro change really drove us to really have to examine and how do we rehabituate our existing customer, as well as I think as an opportunity, introducing listening as a use case to new to customers that never really thought about Audible being in their life and in their habits. And I think really thinking about adapting to these changes and use cases really quickly based on data, how do we actually reintroduce them to and re-educate them that besides commuting, there are other use cases, walking your dog, going to do your chores, doing gardening, and quite frankly, escaping the reality that all of us had experienced in the last couple of years around the globe were some of the insight and data that we rely on. And from a technology standpoint, I'll give a couple case studies real time. In front of end user, obviously, when the lockdown happened, very quickly, within about 10 days of, at least in the US, from a lockdown standpoint, we immediately mobilized and created a free experience because we know that many tens of millions of our members and prospective members, quite frankly, just families in the world are facing being at home with everybody. And so creating that free listening experience using technology to move fast was something that we were able to do. And during that year and a half of that experience and initiative, we actually reached over 25 million unique listener, bring this listening experience to life for folks from over 120 countries. So that's the end user use case. We as a content company as well, create the creative community is also a key stakeholders of ours. So obviously during the pandemic and the lockdown, physical production wasn't available for video production. What we were able to do is actually, with our deep relationship with a lot of talent and narrators, we actually even consulted with a famous British actor, Richard Armitage, to really figure out like, how do we actually take the in-home studio experience to outfit that into all of our talent's home. For those talent that doesn't have the space, we actually have talent that built in-home studio in their closet, in their bathrooms, using technology that we help them to build. We actually ship out over 100 recording kits to our talent and creative community so that we were able to continue those audio production to serve our creative community. We also, when Broadway was locked down, we went and supported that community and actually brought some of those play and worked them out into in-home studio recording setting or via some of these in-home recording kits so that we were able to actually bring the stage to tens of millions of customers' ears. So that's another use case, if you will, in how we use technology to really quickly pivot to serve.
And was that pivot, we're talking about compressed timeframes, was that pivot, much quicker than anything you've experienced before because of obviously COVID and various other things, would you say?
Yeah, absolutely. I think it just accelerated a lot of that, some of these trends that we're seeing from a consumer standpoint, as well from our creator standpoint. But it just really goes to say what we need to do in acting really quickly and being agile.
All right. And Casey, I don't know if there's sort of any good examples from either your perch as sort of CFO of Accenture, the firm, 700,000 employees, or obviously, this big roster of clients you folks have.
Yeah, it's so interesting because Cynthia, I hear all of your examples, and there's just so many use cases that you had within your own enterprise, right? And that just makes me reflect and think about why technology is going to continue to be so important. IT spend, we believe, will continue. And it's really due to the fact of what we're calling total enterprise reinvention. And what that really means is that every part of the enterprise, every part of a company has to really reinvent using technology, data, and AI. So you have to do that across, it's not just one area, one group, one department, it's the entire enterprise. You have to do that and couple it with new ways of working and also making sure that you're engaging with your customers, right? That all of that's going to help you can optimize your operations, but also have opportunities to grow your top line. And so, I guess I continue to reflect on how many places that can go. So what do I mean by total enterprise reinvention? It's areas such as, core functionality and operations of finance, HR, supply chain, right? It's doing things across your enterprise of building the digital core in the cloud and replatforming your business, right? A whole new area that's really big it's ripe for technology and digitization is what we call Industry X, which is engineering and manufacturing. That's an entire new space that will have profound changes in the years to come in the area of technology. And all of that at the end of the day with a continued focus on the relevance of putting customers at the heart of everything. So when you look at how, again, reflect on what Cynthia talked about and what we're doing to ourselves, we're doing this total enterprise reinvention across Accenture, right? And we're very far along in all of the different areas within Accenture, whereas you would hope a very well-run, digitized, technology-driven enterprise, and yet we're not done, right? So we're doing that. We want to be our own best credential in this space. And when we look at it with working with our clients, we're in the early stages of really beginning and then moving to do entire total enterprise reinvention. But it's really exciting because then with that, you can respond so much quicker to what will continue to be an ever rapidly changing world.
And it's great you're both CFOs, right? Because obviously the bottom line, is paramount in both your minds. So I don't know, Cynthia, when you had to make this pivot, obviously probably pretty expensive. So, what were those discussions like? Was it sort of, was it a case of sort of long beating your head against the wall type thing? Did everyone buy in quickly? How did it work at Audible?
I think the way that we think about it internally is at the end of the day, our North Star metric is creating long-term sustainable customer lifetime value, right? In order to create that, as Casey said, it's a whole company. It takes a village. Everybody got to be part of that value chain and creating that value in a compressed time frame in the current environment. And so I think when we break down the problem and look at it from a customer backwards standpoint, it's actually a pretty easy decision. It's the investment that we're investing into the long term. And also, I think it's really making sure that every department are part of this decision and the understanding the needs to be able to invest in some of these foundational infrastructure. Now, for a native digital company, it's perhaps a little bit easier because that's where we exist. That's the space that we play in. And so from our software engineer, our human capital and the talent of our employee, that's super important. We got to be maintaining, we have to be able to build things that are bringing value to our customers, our end user every day in order to, quite frankly, keep our internal talent motivated. So it's really kind of quite a flywheel in all the stakeholders that we serve in. And I think that from a value creation, we keep our North Star on the customer and work our way backwards. That's kind of all the decision that we make.
I know there's been another panel sort of focusing on agility in the year. So is that sort of, what's a key piece of advice, I guess, Accenture will give to its clients? I guess you have the example of Accenture, you can kind of show the benefits, but is there, sort of a playbook you sort of can hand to certain companies, or is it, case by case?
Yeah, I think there are clearly, different ways to go about this. And obviously there are certain methodologies that we use and that we empower our client teams and our clients to work with. But one of the things I would mention, you talked about a previous panel that I thought was kind of interesting too, was one of the benefits that you can get from deploying technology, which is really important to all of us. And I know they talked about this on the ESG and sustainability panel that was also hosted, is that when you do, and Cynthia, you talked about being a digitally native company, right? A lot of companies are not that, right? And they're putting in, they're spending tens or hundreds of millions of dollars on, technology transformation. Well, we're very passionate here, and I know I'm sure the audience is, and clearly, that's the discussion a lot at Davos as well, is on the importance of sustainability and ESG. And so when you do this, you have the ability to, when you do a technology transformation, and I know CFOs all know what this means because we also did a survey that showed that when most companies are looking to who's going to get everything kind of their arms around delivering on the goals and the promises that companies are making in ESG and sustainability, the majority of the time it's the CFO, right? So, but there's ways that when you're doing this spend on technology transformation that you can embed it in from day one, right? So it's not necessarily additional spend, right? But it's something that you need to get done that does pay benefits. So Tom, I know that's a little different from like what's the playbook, but I would say that's something that we say, I would say is in the playbook that we reinforce as all of us are looking to make significant gains in ESG and sustainability, this is one way that you can use that and just embed it in.
Yeah, because as you say, all these huge things are coming along at the same time, which makes this whole thing just particularly challenging. And talking of challenges, I don't know if either of you have any sort of great or painful lessons from these processes, or sort of experiences that might help our audience going through this. I don't know, Cynthia, if you've got any.
Yeah,
I actually
absolutely reflecting on that question. During this, at the start of the pandemic, we were actually undergoing and planning, quite frankly, even pre-pandemic, a pretty major product launch. And in the second quarter of 2020, amidst putting out stories, getting in-home kits outfitted in our narrator homes, we were actually re-examining whether or not we should still go ahead with the product launch. I mean, at the time, there are many other kind of tales of other streaming services that may not have had as successful of a launch. But again, going back to creating value for our customer, observing some of those macro trends that we're already starting to show, and where our customer and where their needs are transforming, we still went ahead and decided that that's the right hypothesis to go down the route and to stay true to the route. And I think that payout, because I think during the pandemic, being able to create a product that are more versatile and have more availability and a variety of different content at a lower price point was really kind of the way that we were examining and we were moving forward. And so I think really staying true to that, and it could have gone many different ways, but we stay true to that. And that was a big lesson learned, at least internally across the department, that, when the hypothesis is there and then the signal is there and the data is there, we continue down that route.
And as this pandemic eases, does Audible have to sort of, is there another pivot in the offing, or?
I think change is the constant, as they say nowadays. And the product launch and the pandemic taught us is that our customer are fast changing. Their behavior is fast changing. And I think if we stay true to creating value for our customer in a sustainable way and focusing on how do we actually create long-term customer value, lifetime value is a metric that we use internally. That's the North Star that we're driving towards. And then, it might take a little bit longer time. And as Casey mentioned, some of these investment that we're putting into infrastructure are enablement for us to grow and enablement for us to scale globally. And so those are some of the internal capital allocation discussion that we have actively, short-term prioritization as well as the long-term.
Got it. And in case I've got to ask, I think Accenture added something like 200,000 employees sort of in recent, is it maybe the past 2 years or something like that, or even less? Is that all? I mean, how on earth do you kind of, again, is that just one of the massive challenges you have to do at the same time? It's kind of bringing new people on, and how do you think about that?
Yes, I mean, I think, going from what Cynthia said, look, change is constant, and we always talk about let there be change here at Accenture, as well as, the pace of change is never going to be as slow as it is today, right? It will never be as slow as it is today, right? So it just means everything's going to accelerate. And so when you look at that, you think, how do you manage that? So you talked about how do we bring so many people on board to Accenture, but I think it plays to all companies, which is saying, when you look at this pace of change, which is, unprecedented and will continue to accelerate, you have to then look at your people, and you have to really look at your talent. And of course, we have 700,000 people, so we look at that maybe even more than many companies, but it's the same for every company. Every business has to be able to access talent, particularly in this constrained environment that we have. And that also means that you have to be a talent creator too, not just a consumer of talent. And you need to really work to figure out, how do you upskill your talent to take them on this fast-paced journey that we're all going on together. And so we really believe that successful companies are going to really consider this and think about talent in a very different way. And you really have to think about your people in doing this technology transformation, in the skilling, the upskilling, the reskilling, retention, and the recruiting of the right skills. So in order to do that, we really think you got to look at different pools. Many companies need to look at different pools of where to get talent to be able to do this technology transformation with you. And that's one of the reasons why managed services has been so strategic for us. Because, what we have done, what we believe through much of our research is that potential is greater than pedigree. And that so we're also able to really expand our talent by the pools that we're sourcing them, that focus really primarily on skills. And so I think that's really a very different way of thinking. And we're looking for people with high learning agility from a wide variety of backgrounds, and to teach them, for high demand skills. So I think that's really an important part of everything that we just talked about on the pace of change and being able to manage with that. And I think on the other side, Tom, you mentioned what are the lessons learned or what are the harder things? I think it's just, this is really hard. You have to be uncomfortable, you have to get comfortable with being uncomfortable. It's the pace of change, as Cynthia said, it's not going to slow down. And so that's also why we focus a lot on people and talent and making sure that you are helping your team and leading the team that works with you day to day, but also for those of us in the C-suite, not underestimating the amount of investment it takes for all of us to get our peers, ourselves, comfortable with the amount of change, right? But it's really is exciting though to think about what we can all do and what technology can really enable all of our companies to do, from those digitally born like Audible, as well as those who are reinventing themselves and have been, clients with us for decades upon decades.
Fantastic. And I know we're into our last few minutes. So Cynthia, I don't know if you have sort of maybe in a couple of sentences your sort of biggest takeaway from all this or where it might go. Any sort of final thoughts from you?
Yeah, reflecting on other things that Casey also said is focusing on, again, customer, but also treating, for us as a content company, creator is key, but employee is also the third prong of how to make all of these work. And so treating our employees' journey and their experience with the company is definitely, as much as what Casey is saying, super resonating with me, is that it's also something that we need to do to care for the people, because as leader, we're kind of at the bottom of the pyramid, and then employee and then customer. And I think kind of that inverted pyramid is also something that we spend a lot of time thinking about at the leadership level at Audible.
I love that. I love that inverted pyramid. I think that's a really cool way of thinking about that. Couldn't agree more.
Well, I think that's a great way to end, actually, because it's fascinating. Obviously, two very different companies, Audible and Accenture, but one thing that did stand out was whether it's or sort of the need to just constantly be alert. You both had sort of very similar experiences or these pieces of advice. So, well, I think with that, I know we're coming up to our time. So I just wanted to thank you, Casey. Thank you, Cynthia. Fantastic conversation. And of course, thank our audience. Thank you very much for listening.
Thank you all for joining Thriving in the New Normal, leading through geopolitical volatility and compressed transformation. We hope you found these conversations interesting and insightful. Thanks again to all of our speakers for making time for this really important topic. And we do also want to thank our presenting sponsor, Accenture. If you'd like more information from our sponsor, please visit the resources tab on your screen. And most of all, thank you all for being such an engaged audience. Lots of important topics we covered. I'm Carol Massar on behalf of the entire team at Bloomberg Live. Thanks so much for watching.